Hello everyone. Welcome back to the channel. In our previous lessons, we explored generally accepted accounting principles or GAAP and saw how they are applied in real financial statements. Now in today's lesson, we're going global. We're going to compare GAAP with International Financial Reporting Standards, commonly known as IFRS, and clearly explain the key differences between them. By the end of this video, you'll understand who uses GAAP and IFRS, how they differ in approach, and the major technical differences that affect financial reporting. Let's get started. 1. What is GAAP and what is IFRS? First, a quick refresher. GAAP is the accounting framework used primarily in the United States. It is issued by the Financial Accounting Standards Board, or FASB. Public companies in the U.S. must follow GAAP when filing reports with the U.S. Securities and Exchange Commission, also known as the SEC. On the other hand, IFRS is used in many countries around the world. It is issued by the International Accounting Standards Board and published as International Financial Reporting Standards. Over 140 countries use IFRS, including most of Europe, parts of Asia, Africa, and South America. So the main difference starts with geography. GAAP, mainly United States. IFRS, international use. 2. Rules-based versus principles-based approach. One of the biggest conceptual differences is how the standards are structured. GAAP is considered rules-based. That means, contains detailed rules, specific guidelines for many situations, extensive documentation requirements. IFRS, on the other hand, is considered principles-based. That means, it focuses more on broad principles. It allows more professional judgment. It provides less detailed rules compared to GAAP. In simple terms, GAAP tells you exactly what to do in many cases. IFRS tells you the principle and allows judgment in applying it. This can sometimes make IFRS more flexible, but also more subjective. 3. Inventory valuation, a major difference. Let's look at a practical example. Inventory. Under GAAP, companies are allowed to use LIFO, last in, first out, to value inventory. Under IFRS, LIFO is not allowed. IFRS permits FIFO, first in, first out, weighted average. Why does this matter? In times of rising prices, LIFO usually results in higher cost of goods sold, lower reported profit, lower taxes. So a U.S. company using GAAP might report lower profit than an international company using IFRS, even if their operations are identical. That's a major difference. 4. Asset valuation, revaluation versus historical cost. Under GAAP, property, plant, and equipment are generally recorded at historical cost and depreciated over time. Under IFRS, companies are allowed to revalue certain assets to fair market value. So under IFRS, if the value of land increases significantly, a company may adjust the carrying value upward. Under GAAP, this upward revaluation is generally not allowed. This means IFRS financial statements may sometimes show higher asset values compared to GAAP. 5. Development costs. Another key difference involves research and development. Under GAAP, research and development costs are generally expensed immediately. Under IFRS, development costs can sometimes be capitalized if certain criteria are met. This means IFRS may show higher assets. GAAP may show lower profit in early stages. Again, financial results can differ even if the business activity is the same. 6. Financial statement presentation. There are also differences in how financial statements are presented. For example, under IFRS, companies present a statement of financial position instead of a balance sheet. While the structure is similar, IFRS often provides more flexibility in formatting. GAAP tends to be more standardized in presentation. 7. Why these differences matter. These differences matter because investors compare companies globally. If one company reports under GAAP and another under IFRS, profits may differ, asset values may differ, financial ratios may differ, even though the businesses operate similarly. This is why analysts must always check which accounting framework is being used. 8. Are GAAP and IFRS converging? Over the years, there have been efforts to reduce differences between GAAP and IFRS. The Financial Accounting Standards Board and the International Accounting Standards Board have worked together on convergence projects. Some standards, like revenue recognition, are now more aligned than in the past. However, full convergence has not yet happened, so differences still exist. Conclusion. To summarize, GAAP is mainly used in the US. IFRS is used internationally. GAAP is rules-based. IFRS is principles-based. There are important technical differences in inventory, asset valuation, and development costs. Understanding both frameworks is essential if you want to analyze global companies or work in international accounting. Now you understand the key differences between GAAP and IFRS. If you found this helpful, don't forget to like, subscribe, and share. Thank you for watching, and I'll see you in the next video.